Thank you very much, Julius. So I'm going to start this market outlook off by taking a look into global grain markets. Like Julius said, a lot has happened over the past 12 months. I'm going to take a look at the key themes for what factors are keeping that global supply tight, and can a global recession alter this balance? And we're going to take a real focus on wheat markets today, global wheat markets, as a key driver of global grain markets. So let's get straight into it. This season we have seen domestic futures prices supported by global strength. As we can see in the graph on the right hand side, domestic futures continue to move with global contracts. Last season, prices were supported on extreme weather, causing major producing nations to see large production swings, plus elevated by the war in Ukraine. We brought that tight supply and demand balance into this season too, with the ongoing conflict creating uncertainty and volatility in the market. But how high are current prices if we take out inflation? If you take your attention to the left-hand side graph, we have recalculated UK feed wheat futures by using the Food Consumer Price Index and re-indexing this to July 2000 to remove inflation, and so that we can compare to the past 20 years of price changes to see where our current prices are. By doing this, average UK feed wheat futures for October were around £90 to £100 lower than they were trading in real time. That was at around the £176 per tonne mark. It is above previous peaks in 2000, in 2008, 2011 and 2012, but perhaps not quite as high as some might have expected. So taking a look into our global grain supply and demand balance and delving into those stocks to use graphs. As you can see in the maps that you have in your packs, the key thing to note over the past 2 seasons is that we have seen large production swings. So as you'll see in the production map, 30, 40, 50% changes on the year. Countries have been battling drought and more extreme weather. We have seen production rebounds in key areas of Canada, the US and Russia, but stocks still remain tight for those global grains. And we can expect more global production swings, and that's something that we're going to have to be aware of going forward, keeping price volatility. Arguably, considering the active war in Ukraine at the moment, these stocks to use graphs do not actually show the true balance of what's on the market, and creating continued uncertainty and price volatility, and we're going to reassess that today. So moving on to the key underlying market driver creating uncertainty and volatility in the market is the invasion of Ukraine. The key question here is, how is this impacting grain leaving the region, the Black Sea region? Well, we're going to move on to it in a minute, but actually Black Sea grain is pricing pretty competitive. Russian wheat is matching pace with last season, as you can see in the graph on the right hand side. Despite Western countries putting sanctions on Russia, making that exporting a little bit difficult, but we are still seeing pace of Russian wheat exports. The UN export deal has been extended from the 18th of November for another 120 days. During these negotiations, we did see Russia push quite hard for an easing of some of these restrictions to make exporting that little bit easier. And that Russian wheat crop was forecasted to be between that 90 to 100 million tonne mark. Since the establishment of the Black Sea grain deal, we have seen grain flowing out of Ukraine, and that has been picking up pace. Maize and wheat have been the key crops that have been leaving port especially, and they've been heading via the EU by a significant number. As you can see in the graph on the left hand side, Ukrainian maize export is ahead of last year's pace, but wheat is lagging. But we have seen that export pace picking up strength in the past couple of months, and the keeping of the Ukrainian export corridor open, that Black Sea export corridor open, really is significant to keep the flow of competitive grain from Ukraine. But overall, we can expect volatility to stay. This conflict remains very live, developing all of the time, and that will keep price volatility in the market. Any news on the conflict will certainly be moved on, and that is reflected in price volatility that we are seeing at the moment. Moving on, we have talked about the tight global supply from drought conditions across the globe, and of course the war in Ukraine. So how is this impacting trade, and where are origins priced at the moment? As we can see on the graph on that red line, Ukrainian wheat is still pretty competitive, and Russian wheat too, as you can see in the table, is also pretty competitive currently. That large Russian crop is on the market, and it is getting picked up in many global tenders. On the other side of the coin, as you can see in the blue and grey lines, the US wheat is pretty uncompetitive at the moment. It is quite expensive compared to other origins. Plus Argentinian origin is also pretty uncompetitive, considering the drought conditions that they have seen over the season, trimming yield potential right back. And as we can see in the graph, EU is sitting in that middle ground. So let's tie all of these factors together. So major exporting countries that have suffered production swings, the war that is ongoing in Ukraine, and which origins are competitive, we can reassess the supply for major exporters, total wheat exports, and really how tight this balance feels. Official USDA estimates are pegging that number at 180 million tonnes. The IGC estimate is just below 176 million tonnes, and that is based on lower exports forecasted in Russia, Canada, the EU, but higher exports expected from Ukraine this season. Using data available to us, we can recalculate these export numbers. AHDB expectations are similar to the IGC figures, tighter than estimated by the USDA, at just above that 176 million tonne mark. We are bolder on Ukrainian wheat exports, considering the picking up of pace that we've seen, and providing that the grain corridor does stay open, and we're more in line with the IGC number. But conservative on what is expected from Argentina, considering the recent drought that they have been suffering, as well as the EU and Russia. The EU are currently running around 5% ahead of last year's exports. Russian wheat is competitive now, as we have seen in the graph and talked about, and we do still expect those export levels to be the highest since 2017-18. But rail carts remain an issue for Russian exporters with a several month wait. And also farmer selling is something to think about as well, considering less trust in the banking system and more in commodity value. Plus, looking ahead to next year's Russian wheat crop, that is forecasted to be circa 15 million tonnes smaller for harvest 2023. So, question marks surround how much wheat can be exported. Finally, the key thing to note is what could happen, if this corridor, if the Black Sea export corridor was removed and it's not rolled over once the 120 days period has ended. The tightening of this on the market will keep the market sensitive to any new news and keep that price volatility in the market. Now, let's move on to another key underlying factor in the market, and that is a global recession. The UK are now reportedly in a recession. GDP figures fell for September, and inflation for October was at that 10% mark. But what about the rest of the world? Well, as the saying goes, the US sneeze and the world catches a cold. Let's take a look at the US. Overall, GDP remained positive in the latest figures for the US, but if we delve a little deeper into those food and energy, that picture looks slightly different. Plus, considering the latest movement of the US dollar, we have seen some weakening of the US dollar in recent weeks as concerns grow around the US economy. So key nations are expected to feel a recession in 2023. And that is likely to have an impact on disposable income, on consumer confidence, and of course demand across the sectors. And it's definitely something to think about when we're considering that balance between supply and demand. We know a lot about that supply side, but really concentrate, on demand going forward. How tight might that balance feel? Finally, before we conclude, let's take a look at the floor of the grain market, and that is maize. As we can see on the graph, average US maize futures remain strong even compared to the last couple of seasons. As we saw earlier on the stocks to use graph, and of course on those production maps, supply remains tight due to those drought conditions that we're seeing in recent seasons, this season in the EU, and of course the difficulties that are ongoing in Ukraine. Difficulties getting maize out of the field, with some concerns that we might have to overwinter some maize in field due to harvesting difficulties plus fuel shortages. Argentinian dryness is also something to watch for supply going forward. That maize crop is around 24% planted, slower than previous seasons. Plantings are progressing slowly, but they are progressing, but the dry conditions are certainly something to watch. But really, the factors to consider are the demand side, as we've discussed around the recession. US ethanol production and exports are especially strong currently, but on the other side, US maize exports specifically are lagging last year. China also remains a watch point considering their COVID policy, their no-tolerance COVID policy, as well as COVID resurgence that they have seen over the past month or so. And question marks remain over the EU margins for ethanol, considering the high energy and feedstock prices that we have been seeing. And finally, that recession point that we've just talked about as well, the impact that will have on fuel demand and of course maize demand as well. So to conclude, we might not see the return of those high prices seen back in May, and as inflation comes down, we could see some price deflation. But we can expect that tight global supply to continue to support those price levels. As we reflected on through our recalculation of the major global wheat exporters' total exports, supply on the global market remains constrained. Lately, as we have been seeing prices come down, we've seen some bargain buying on the global market, bringing those support levels back up again. Plus, looking ahead to harvest 2023, the global grain supply still looks to be constrained and tight. So lower Ukrainian plantings, as we can see on the graph, lower Russian plantings, and of course the dry conditions that remain across the globe in the EU and in parts in the UK as well. But a recession would likely see some demand rationing, and that could loosen that balance. But the severity of a forecasted recession is something that we do not know yet, and certainly something to watch going forward. Finally, expect volatility to stay. Considering that tight global supply that's available, and unfortunately the active war that we are seeing ongoing. But things that could change this balance, certainly watch points for us that we'd like to know more about. Firstly, Argentinian dryness and the impact on that maize crop. Considering the ongoing La Nina. Plus the Australian quality and quantity of their grain crops as well, considering the recent flooding and large rainfall that they have been seeing. So thank you very much. That concludes the global grain outlook.
I'm now going to take you through the UK supply and demand outlook for the season, including the first official UK supply and demand estimates for the 2022-23 season, which were released just this morning. We will look at what is in store this season for demand and trade for both wheat and barley, and what the key watch points are going forward. So we'll start off by setting the scene for this season by looking at the wheat and barley situation last year, which was a story of two halves. I don't think anyone would argue with me when I say that the 2021-2022 marketing year was unprecedented in terms of price movements driven by the invasion of Ukraine. Despite a larger domestic crop in 21, with such volatility in the market, we saw a reduction in farmer selling towards the end of the season, which also led to more being imported than initially anticipated from March to June. These combined led to larger closing stocks for wheat for the 21-2022 season. For barley, the 21 crop was considerably smaller than the year before. Usage of barley last season remained strong during the first quarter, which was a lag from the previous year when supply was plentiful. The barley balance sheet became increasingly tight as the season progressed, which led to end season stocks coming in at just under 1 million tonnes, the lowest level in nearly a decade. With larger 21-22 carry-out stocks for wheat, that means heavier carrying stocks obviously for this season. While there is yet to be an official DEFRA UK production figure released for harvest 2022 due to reduced data from the devolved nations, we have calculated production figure by combining the DEFRA England data with estimates for the devolved nations by using our planting and variety survey area and industry input for yields. As a result, for harvest 2022, the UK wheat crop is provisionally estimated at 15.7 million tonnes, which is up 1.7 million tonnes on the year. While the area planted for harvest 2022 was expected to remain relatively stable on the year, higher than average yields has driven the rise in output. The rise in production on top of the higher carry in stocks has led to a rise in total availability this season. Before we get on to looking at this season's balance sheet in full, I want to take a look at the quality of this year's wheat crop. The title of this slide, Amongst the Best Seen, nods to the high specific weights and Hagberg falling numbers from this year's crop, with big, bold, bright grains being reported. However, there is the big caveat of protein content. The content isn't quite there, with the hot and dry conditions in the spring and summer thought to have impacted the uptake of nitrogen from farmers' last applications, if they actually applied it at all with the rise in input costs. So while this year the AHDB Cereal Quality Survey included a smaller sample, it still gives a good indication of what quality is like this season. According to the results of the final survey, 33% of UK flour miller Group 1 samples met optimum milling wheat specification. This is higher than last season, when just 20% met spec, but that was largely driven by lower specific weights and Hagberg falling numbers rather than protein. The average protein content for Group 1 milling samples this year came in at 12.6%. This was compared with 13.2% in 2021. So the tightness in high protein milling wheat this season is very much reflected in the milling wheat premium. For the month of November so far, the premium of average UK ex-farm milling wheat over ex-farm feed wheat stands at nearly £47 per tonne. This is higher than this point last year and even higher than November 2018, a year when protein levels were hit by adverse weather conditions during harvest. So what does this all mean for usage and demand for this season? Well, it wasn't just the UK that was impacted by hot, dry conditions this summer, mainland Europe was too. With two of our key milling wheat import origins, France and Germany recording lower protein levels too. It is expected that this season, millers will use a slightly higher proportion of homegrown wheat with the higher specific weights and Hagberg falling numbers. However, the rise in homegrown usage will be capped with a certain amount of higher protein content imported grain required from the likes of Canada, especially with gluten additive prices rising too. So I have touched on a few areas of supply and demand for this season so far, but now I'm going to take you through the first official 2022-23 estimates, which were released just this morning. As mentioned previously, higher carry-in stocks and bumper crop has led to a larger availability of wheat, despite imports being trimmed back slightly. In terms of usage, we are expecting human and industrial usage to be up on the year, driven largely by a rise in bioethanol and starch demand. Both UK bioethanol plants are expected to be in operation for the full season, however not at full capacity, partly due to longer maintenance periods. With wheat being more price competitive than maize, it is likely that maize usage will fall, but not drop out of bioethanol inclusions altogether. There's also expected to be an increase in starch capacity this season, with a rise in wheat usage factored into these balance sheets. Demand for wheat and feed rations is expected to remain relatively stable on the year, even though wheat is forecast to actually be included at higher rates due to the higher availability. The overall projected decline in animal feed, particularly driven by the monogastric sector, will cap any gains for wheat this season. So, with the rise in availability outweighing the rise in usage this season, the supply and demand balance is expected to grow to 3.75 million tonnes, which is 1.1 million tonnes higher year on year. Taking into account an estimated operating stock requirement of 1.5 million tonnes, that leaves a surplus available for either export or free stock of 2.25 million tonnes. That's over 1.5 times higher than levels recorded last season and the highest since 15-16. So is this going to be exported or carried over? With the volatility in global markets stabilising somewhat since the Ukraine export deal was extended, it is unlikely that we will see prices go back up to levels we saw earlier in the spring. However, as long as the war does continue, this will continue to act as a price floor for markets. With a large surplus of grain this season, it is likely we will see prices at some point move to compete on the export market to simply shift some of this surplus we have. With prices likely to rise considerably in at least the short to mid-term, it's important to assess your marketing strategies.
In terms of what the impact of these high costs have been, as sort of Millie has sort of indicated, that we are going to see these elevated higher input prices continue. But looking back over the last 5 years of Farmbench data, between the 5 years of 2017 to 2021, we've seen the cost of production there increase by about 6% for those middle 50% performers. In 2022, with the sort of prices that we saw of inputs sort of gradually increase over that time, we're going to see part of that year sort of impacted by those high prices, and so we could see cost of production for the harvest 22 crops estimated to be about 15% higher than what we were in 2021. For 2023, we're probably going to have a whole year of these elevated input prices. So the impact of that is going to be another sort of 32% increase on average across all combinable crops for the 2023 harvested crops. And if we just look specifically at winter wheat, for example, in 2022 we're expecting margins could increase by about 80%, but then fall by 2/3 because of these continued elevated high input prices for these middle 50% performers for 2023. So we could see some quite sort of significant changes here. Let's go into the detail of that now. Firstly, just a little bit of background about analysis so you can see where we're coming from. Firstly, the Farmbench data. So for this analysis, for the historical data, we looked at over 11,000 combinable crop enterprise performance results for the 5 years up to 2021. And you can see there a list of all the crops that we can analyse. And if you do Farmbench yourself, these are sort of crops that you can compare against as well. The 2022 figures, as I alluded to just a moment ago, are partly based on the fact that we're going to see some of these high input prices applied to part of that harvest year. But for 2023, we're expecting that to be for the whole of that production year. So, and that's based on what we think the prices are at the moment. And so there's obviously some assumption there. But the other thing we've assumed is that there's also been a reduction in the application rates of fertiliser, and nitrogen fertiliser in particular. And certainly when I've spoken to growers and agronomists and that sort of thing, there's been a range of roughly 0 to 20% reduction in nitrogen fertiliser application rates this last year. So we've taken a mean of sort of 10% in our analysis here. So that's just a very quick run through of the background for the figures. Let's have a look at the figures in terms of the last 5 years, starting with the average prices for the different crops. And I think what I'd like to say here is that over the last 3 years, we've seen generally an upward trend in the average prices being recorded by Farmbench users. And this is the average across all those users across those 5 years. Particularly, you can see the oilseeds are particularly spiked in 2021. But generally, most of those crops have seen an increase over the last 3 years. What about yields? Well, yields pretty much been a sort of roller coaster really sort of reflecting the mix of seasons that we've seen in the last 5 years. So probably no surprises there, but it just goes to show how much we do see those yields going up and down depending on what sort of production season we have. And if we combine then both the yields obviously and then the average prices, we get our income of course. And here what I'm showing is in the solid lines, they are the top 25% for winter wheat, oilseed, rape and spring barley, and those dotted lines are the bottom 25%, and they are ranked according to net margin. And you can see there that the 5 years up to 2021, we've seen an increase in income for all those crops, so both the top and bottom, but particularly the top where we've seen it increase by about £500 to £800 per hectare in terms of income. Actually, we've seen one crop in the bottom 25% where there was actually a decrease over that time of about £40 per hectare, and the largest increase was on the £300 per hectare. So actually, being in the top 25% performance level has allowed that group to really take advantage of what we've seen over the last five years in terms of prices. Gross margins, what do they look like? So let's have a look at those. And they sort of vary a bit, so we've got some very significant increase in gross margins in 2021 with those high prices we've seen in some of those crops. But again, a little bit up and down in terms of the middle 50% performance. But then let's have a look at sort of just the costs in total. And as I just alluded to at the start, we've got average cost reduction over the last 5 years going up 6% on average. And then this chart really sort of shows what impact these higher input prices will have on cost reduction for this harvest year we just had and the forthcoming harvest year in 2023. So, you know, we're seeing another 15% increase in cost production compared to last year for 2022 and a further 32% on that in 2023. Again, quite significant and quite stark when you see it like that. But how those net margins look like, this is taking an average of the net margins across all the crops, separated out by those performance levels, again ranked by net margin. So those top 25% crops, they've all made a positive margin, and compare that to the bottom 25% where they've all made a negative margin. The middle 50% are somewhere in the middle, as you probably would expect. So there's quite a difference there between what that top 25% are doing and what the bottom 25% are doing. And I can sort of illustrate that in this next chart, which sort of highlights what the drivers between the difference of why there is between that top 25% and the bottom group. So this is a chart, this is looking at net margin versus total overheads as a percentage of income. So each of these dots on this chart represents a crop from a year between 2017 and 2021, and whether that's taking an average of being in the top, middle or bottom performance group. So this just shows such a close relationship between these two metrics. So what we're saying here is that the lower your total overheads is as a percentage of income, the higher net margin. So hence why we see those blue dots, the top 25%, they've got lower overheads as a percentage of income, around about the sort of 50, 60, 40% sort of area, and hence their net margin is higher, and hence why they're in that top 25%. And you're probably wondering what those two extremes are in terms of those in terms of that relationship. So let's just highlight a couple of those. So for example, on the sort of high side in terms of overhead percentages, winter beans, the 2020 bottom 25% results, they had overheads of around about 270% of their income. So basically, their yield, their income was much lower than the cost that was put into that crop. So hence why that's so extreme on that side of the chart. On the other side, we've got winter oilseed rape. The top 25% achieved a total overheads of about sort of 40% as a percentage of income in 2021, and so that net margin was significantly over sort of £1,000 per hectare. So this summarises the two sort of key drivers really between the top and bottom 25%, which is the level of overheads and income. And income is mostly driven by yield more than price up until now. Let's have a look forward then. Let's have a look at what 2022 estimates are in 2023. Just to give you a bit of background in terms of the assumptions we've made around prices, as you can see here, and the forward crop prices. Obviously, prices have been quite volatile recently, so it's been quite difficult to try and peg this somewhere. But we've gone with these prices for this analysis. But the yields we've used here are the 5-year averages for crop bench users in this last 5 years, obviously, and they've been very similar actually to the 2021 results. So, taking into account those, I think probably going forward we'll see prices have a greater impact than we've seen in previous years. Generally, when you compare top and bottom 25% in terms of the average prices received, you don't see actually a significant difference between the two. Generally, it's around about £5–6 a tonne. But with the volatility we're seeing at the moment, and whenever you sort of market those grains and oilseeds, it may well impact in terms of that difference. So I think we'll see a greater impact on prices and on the margins going forward. So let's have a look at what the cost of production figures look like, so taking into account what we just said earlier. So for 2022, winter wheat to start off with, we're probably expecting about an 18% increase in the cost of production for the middle 50% group, and that increasing up to 38% next year. That's similar actually for spring barley and oilseed rape. How does that impact in terms of net margins, taking into account the assumptions we've made? Well, in terms of winter wheat, we've still got some positive margin there in terms of the net margin for winter wheat for the middle 50%, but for spring barley and for oilseed rape, it's looking negative for next year because of those higher prices and the higher costs. So it's not looking so great with those. But let's not sort of always think it's going to be negative like that, because let's compare to what maybe the top 25% may get in terms of their net margin. So this is net margin for the middle 50%. And let's look at what, if we apply the performance levels that we see in the top 25%, and what we'll see there is actually then for the 2023 crops, positive margins. So it probably goes without saying, it's probably never been a better time to be performing at the top 25% level when we've seen the sort of tightness of margins that we are because of the higher input prices, to be able to sort of ride out that volatility and those high costs. Actually, the top 25%, hopefully you'll still be able to do that with the performance levels that you've been previously getting. So just to summarise the key results then, in terms of those first 5 years, 2017 to 2021, prices generally kept pace with the gradual cost increases. Winter wheat still was the best paid sort of cash crop alongside oilseed rape and oats. In terms of 2022, we've got that influence of the high prices coming in during that production year. So we could see the cost of production rise by about 50%, but margins also increased by around 80%. But for 2023, that's when we're going to see the full impact of the cost of production. And we're saying on average, it could be around about 32%. We saw in wheat, it could be about 38% up on this year. So we're going to see net margins probably go down by up to 65%, for example, in wheat, but it'll still be positive in terms of the middle 50%, and definitely looking like it'll be positive for the top 25% at those production levels. So just leaving with that slide as well, just to give you a range of the support tools that we have in AHDB that can sort of help in terms of looking at how you can manage those cost of production and help us with those decision-making things that we need to do in regards to how can we mitigate some of these high costs and still get reasonable margins. Thank you very much.